Hey, what's up, everyone, and welcome back for Wednesday, March 5th. Today, the market was positive. The S&P was up 1.12%, Dow 1.14%, NASDAQ Composite was up 1.46%, and the New York Stock Exchange Composite was up 1.13%. So green across the board, finally. It only really took since last Friday for another green day to come in. To be honest with you, I have been, knee-deep in programming stuff today, so I have not really been paying attention to the market or trying to keep up with what's going on. I did take a quick look at the end of the day and saw that everything was green, and that's pretty nice. And honestly, if you know me and you know the methods that I've been coaching, you'll understand that one of the things that I coach is that you don't need to check and look up to see how your portfolio did every single day. You really want to construct it in a way where your strategy, gives you that confidence where you can just kind of check in every few weeks. Now, I do kind of take a look at to see how the market did, and I do track the stocks that are in my portfolio. So if I wanted to, a quick glance down at my phone and I can tell exactly where everything is at. But understand that the principles behind what we're coaching here is all about having a strategy that's not promoting day trading or anything like that. It's more about, a good long-term strategy and developing an understanding of how frequently you need to rebalance that portfolio. That's certainly a part of the program and one of the things that we test here. Now, in terms of today's top strategies, Trainers Measure had another day on top. The top return was for 15 years with 5 stocks experienced a 3.43% return. So great return for them. As a reminder, we talked about Trainers Measure briefly in our video yesterday, but it's a measure of that risk premium over beta. So it's how much return you're earning for each movement in the market, essentially, and it's a measure of volatility, and it's generally indicative when you see it here that the algorithms or the folks on Wall Street that are handling all the volume are moving more towards assets that make money off of volatility rather than more of that traditional long-term growth. Now, it still can be an identifier of some phenomenal companies, but just in general, that's kind of how I view it. In terms of the highest volumes for today, a lot of similar names on here: NVIDIA, Intel, Palantir. I don't see Tesla on the list. They're probably just outside the top 10 because they usually see a lot of volume, but they've been down the last few days, so I don't know what their trading volume is like today. And then in terms of the biggest gains and losses, on the gains, I don't really recognize any of these companies, so I'm not going to comment on any of them because I don't have anything to say. And then on the biggest losses, again, you can see China Liberal Education Holdings. I'm not laughing at them for their loss. It's just they keep popping back and forth between these two lists the last few days. And if you've watched the videos, you've seen that. As well, Sonova Energy on Friday had like a 64% loss. They experienced another nearly 18% loss on the day today. So let's take a look at our portfolio. All right, so a green day, good. However, the S&P 500 outperformed our portfolio. So it's always great to see, a gain, but obviously we would have liked to see a little bit more. I probably would have been happy if there was a 1 in front of that, where it would have been 1.57% for the day instead of 0.57%. That would have been much nicer, would have made me happy. As you can see through yesterday, the returns had converged and our portfolio had actually moved into being slightly ahead of the S&P 500. And then looking at today with the S&P 500 having a better gain, now, of course, the S&P 500 is back in the lead. Now, both of us are experiencing a loss since the initial investment was made, but that's just kind of been the trend in the market the last few days. All right, one other thing, I seem to bring them up almost every day, MNSO Group, but they did experience a nice gain in this portfolio today. They're somebody that I just find them fascinating. I think, when you think about global trade dynamics right now with the tariffs and everything, it's a conversation a lot of people are having at the moment and learning more about. Investing in companies that are not necessarily based in the United States, a lot of people do prefer to shy away from that, understandably so. Regulatory environments in other markets can vary. That's not a comment about the Chinese market. It's just they can vary from one market to the next, and it can be unpredictable in some of the markets that are outside of the U.S., at least in terms of for traditional retail investors. MNSO Group, however, is a company that I came across a couple weeks ago while doing a series that I do on the side called Industry Explorer, where I do the top 10 or top 15 companies based on market cap for a particular industry. And I was going through the retail sector, and they are essentially they're a Chinese company. They're based out of China, but they take Japanese-inspired goods, and then they make them cheaply in China, and then they sell and market them sort of like if you live in the U.S., like a TJ Maxx, or Canadians you might be familiar with like a TJX. It's that kind of retail level, but it's all brand new, nice goods designed and styled, kind of after what's popular in Japanese culture. And when you look at China and a lot of the Chinese brands, I know traditionally in the West, in the US and the UK, people are right now kind of taking defensive positions almost. But when you think about global trade dynamics over the last 10, 15 years, I saw a chart posted yesterday by Visual Capitalist. You should follow them if you don't. They post some really great graphics that they put a lot of research behind. There's some wonderful people that work there putting those visualizations out. And they had this graphic that showed the trade dominance globally and where the US was at in, I think it was 2005, and China, and where we are today in 2025. And much more of that chart is dominated by China. So to me, when you think about that firm, MNSO Group, I think about the growth, that the potential that they have, not only within their own domestic market, which obviously is experiencing some challenges at the moment, but internationally as Chinese influence grows. And I think that's something that, at least me personally, I'm going to spend a lot more time this year trying to understand some of the stronger Chinese companies that are out there to determine if that's something that I want to include in my portfolio. And I think what you'll find is, as we move forward with this portfolio, kind of whether I want to or not, I'm going to make changes with it just to demonstrate how to do that for the purposes of these videos. But it wouldn't surprise me at all if MNSO Group is a company that I end up holding on to for the vast majority of this year, if not longer. Watch, I'll Jim Cramer this, tomorrow it'll tank and I'll be down like 20% or something like that. But I don't know. I really like, I really like this company and their mission and how they're going about things. And it's just one that I came across. I'm not necessarily recommending it for you or anything like that, but certainly take a look at them. I think that they've got a bright future there. All right, so the last few days I've taken a little bit of time in order to introduce another topic. But today what I want to do is I actually have another username that I have on here that I log into that has a number of other portfolios in it. So I want to go into that username and kind of show you the performance of some of those portfolios so you can just get a better understanding of how this looks for some portfolios that have actually been put together a little bit longer. I finished these tools in about, I think it was late January, early February. This is all very new in terms of these web tools, and some of the initial portfolios that I built out of there. I built a few that kind of mirrored and monitored some of the, we'll just call them the bigwigs that are out there, the Warren Buffetts of the world, if you will. And then I created a few of my own. So I'm going to switch over to that account and I'll show you what that looks like. Okay, so the first portfolio that I brought up is the one that mirrors Warren Buffett's, or at least Warren Buffett's at the time that I created it. So you can see here, one of the points of emphasis that I wanted to make is about indexing your portfolio and trying to get it to mimic the returns in the market. And Warren Buffett is one, if not the person that is most well known for being able to fairly consistently beat the market. So taking a look at his portfolio, you can kind of take a look. Initially, I loaded these on January 31st. So from that point moving forward, he had a very similar return to the market. Then on about February 10th, he began to separate himself, and you can see that his return was considerably higher than the markets. He was at about a 4-point return, whereas the market had lost about 1.7% right there as of February 28th. Now, as we're getting into February, you can see those patterns starting to converge a little bit. But one of the things that I noticed when I was looking at this portfolio earlier today that I thought was interesting was when it quantifies its expected return and risk, or the standard deviation. These numbers right here that are shown are based on daily amounts, daily return, daily risk. And I built a lot of different portfolios on here. I've never been able to. Now you could debate, hey Matt, you need to add some more decimals to your zeros here, but I've never been able to totally and completely eliminate the risk. And I was thinking about that today while I was looking at this. And if you think about Berkshire Hathaway as a whole and that entire organization that supports, what he does, and then obviously much greater, beyond that. But this is the portfolio of stocks that they essentially hold. A good investment fund manager, it's their job to mitigate risk and to be able to produce a return while almost eliminating the risk. And when you look at his portfolio, I realize that that's what they're doing. They're just eliminating the risk in his portfolio. So, and when you look at it, it's kind of interesting because I even took their weights and pushed them into this tool, but I even used the optimizer at the time. And the optimizer, if you don't know, it's a tool that tests like 10,000 different combinations of those assets to see which one performed the best over time, which means produce the most return while taking on the least amount of risk. So it tested all these different combinations, and it showed me a result that is very similar to the portfolio that he actually has. And then it's been interesting tracking it over time here. That realization came to me that there's no risk. Now, there's still some risk there. There's just not enough decimals here. But that's the job of his team, is being able to make this number here go up while making this one go down. So, and obviously they're doing a phenomenal job of it, because let me go over here to another portfolio. This was just one that I had thrown together. You can see that Arcadium Lithium company that I had mentioned and have included in the live portfolio here that I'm trading was a part of this portfolio as well. But then there were a number of other companies that I included. There's Mr. Car Wash, an ETF, a 20-year Treasury bond ETF, as a way to try to help kind of, instead of including the risk-free assets as part of the portfolio, sometimes you can just consider potentially ETFs. But also SoFi Technologies, they had a great year last year. They're very well positioned. Archer Aviation, they're a company I'd recommend you look up if you don't know what they are. They're essentially building flying VTOL vehicles for future flight globally, which is very unique and interesting. And I know there's several people that are in that field, but they have a lot of backing and a lot of sponsorship by major industrial players. So right now it's looking out of a few competitors that are out there, they're definitely positioned once all of this receives the final FAA approval to do well. But right now they're actually down quite a bit. Then Liquidity Services and SoundHound AI. I felt like, I don't know for sure what Liquidity Services does, but if they work with bankruptcies or churning liquidity for bankrupted companies, something of that, I think this year is actually going to be a pretty busy year for folks like that. It's going to be a great year for a lot of people, but there's a lot of companies, industries that are out there that are kind of teetering and on the edge. And I think a lot of this tariff business is going to, unfortunately, negatively affect a large number of people. I'm not smart enough to sit here and tell you how or where or who, but I know for sure that there are definitely going to be some businesses that go under this year, and then there's going to be a lot of opportunity for individuals to capitalize on that and take over some of those assets. So if you're a young person, you got money, and you're trying to think about what's your next move, or maybe you want to start a company, sometimes don't even think about starting a company. Think about buying a company or buying a formerly bankrupted company or its assets, and starting from that point, because even government surplus, you can save a lot of money going that route. Sometimes it's not always going to be the right fit for everybody, but always think about other options as well. But this portfolio, and really the intention of why I brought you here, was to show you that this one absolutely has risk in it. Now, yes, the expected return shows up as much higher. So, hey, you have that potential there to earn a lot higher return. But the risk is there as well. And it doesn't look like a lot, but in comparison to Warren Buffett's portfolio, it's significant. It's significantly more. So you need to consider those types of things. So let's go over to the trends real quick, and then I'll let you go. But even taking a look at the trends here, you can see just how much more dramatic some of these returns were. The gray line is the S&P 500. The green is the portfolio. So since February 14th, when this portfolio was created, the S&P 500 has actually lost almost 4.5%, whereas this portfolio has only lost 3.69%. However, you can see for the first week and a half, the portfolio is experiencing a much larger loss than the S&P 500, whereas then it jumped back to the other side. So that's just something to kind of consider and understand with being able to manage risk. It's going to translate to your portfolio's beta, and that's going to be how much your returns from a day-to-day basis, kind of how much are they magnifying that daily return? Is it going to mirror what the market is doing, or is your portfolio, by not mitigating that risk, forcing you to stomach a lot more, variability from a day-to-day basis? So that's just something to consider as you're building portfolios, testing different combinations. That's really a big part of your goal, is mitigating that risk and trying to get it down as low as possible, because the lower you can get it, the more likely your portfolio is going to mimic the market's return. And that's ultimately what you want to do. You want to be able to produce a market-based return, owning the assets that you want. And a lot of people will say, well, Matt, why don't you just buy an ETF? Well, because then you don't get the ownership rights. You don't get the voting rights. And me personally, I want to be a shareholder. And also, if you saw some of my episodes last week and you take a look at the performance of certain of the ETFs as an industry or as a sector, funds as a sector, worst performing fund. And you could say, well, there's a lot of them, 737. Yeah, but there's 754 technology companies, and they're number 2. There's 1,120 healthcare companies, and on average, they're number 4. So, that's not to say that there aren't good funds out there. There are definitely some good funds out there, but you got to do your research, just like anything else, just like stocks. And to me, if I'm going to take all of my money and I want to put it into something, I want to know that I have a certain level of control with that. And by investing in the shares, by gaining those voter rights, that helps to kind of alleviate that feeling for needing some control, because then I have an ability to communicate with that corporation and to potentially hold them accountable if they're going in a direction that I'm not too excited about. All right, well, I think that's my soapbox for tonight. I kind of rambled on a little bit longer than I expected to. But as always, I appreciate you being here. Have a great night, and I'll see you tomorrow.